Okay, so imagine this. You're ruling a country and you need more money in budget. Then a brilliant idea crossed your mind. Raise the taxes. You introduce a higher tax rates, but oh no, your revenue, instead of going up, went south. Why is that? You've put yourself on the right but wrong side of the Laffer Curve. What's that? And how does it work? Well, the Laffer Curve was created in 1974 by none other than American economist Arthur Laffer, whom, according to legend, wrote it on the napkin. The idea was pretty simple. If the tax rate is equal to 0%, tax revenue will also be equal to 0, as no one is taxed. But what if we set up tax rate to 100%? How much the income would be? Also 0, as no one would go to work if they would have to give away everything they worked for. Pretty obvious, isn't it? Are there real-life examples of it? Of course they are. In 1981, when Ronald Reagan took the office, the top marginal income tax rate in the United States was 70%. And the tax revenue for this year was $599 billion. But due to Economic Recovery Tax Act of 1981, tax rate for 1982 was cut from 70 to 50%. And what happened? When the tax cuts took their full effects in 1983, revenue initially dipped. But over the years, it recovered. In 1986, Reagan introduced a second, major tax cut, also known as the Tax Reform Act of 1986, which reduced the personal income tax rate from 50% to 38.5%, and for following years to 28%. Despite this, revenue continues to grow. Some of you might say, this means that we should immediately start lowering taxes. Well, not so fast. Despite the fact that US tax revenue increased, there are two things we should keep in mind. 1. Despite the fact that revenue increased, its share in GDP fell. Let's look at the numbers. In 1981, revenue of $599 billion shared 19.6% of GDP, when $991 billion in 1989 shared only 18.4%. If the Laffer Curve worked as predicted, share of GDP should have increased, but it fell. And 2, despite lowering tax rates, Reagan reforms closed tax loopholes by removing many deductions, exemptions, and simplifying tax code, making tax base broadened, meaning more people were taxed on a wider range of income even though rates were lower. Some might say, that means Laffer Curve doesn't work. Not so fast. As we already said, Laffer's observation was correct, but the main question he couldn't answer was where curve reaches its maximum point. So, where is it? It depends, and is individual for each country, and is determined by many factors like social perception of taxes, size of the informal economy, efficiency of tax collection, welfare state preferences, and many more. So, finally, how does Laffer Curve looks like? Well, it definitely doesn't look like on this graph, where as we look closer everything is technically correct, but it might suggest that the curve is symmetrical, and it reaches its maximum point at tax rate of 50%, which is not true. Also, this representation of Laffer Curve, which shows maximum point at 30%, is also entirely false. And here comes the bitter part. Today's research says that the maximum point of Laffer Curve is estimated at the tax rate of around 70%. Pretty disappointing, isn't it? But who said that the curve has to have only one turning point? Nothing suggests it's impossible to think that the graph might look like this, where after increasing tax rate from 40 to 50%, revenue might decrease. But further tax increases could then increase revenue. This is because people affected by the tax hikes might have already moved to the grey market or stopped business activity, leaving only those who will pay the taxes regardless. So, answering main question of this video, do higher taxes always lead to more revenue? Not always. But as Laffer Curve looks more like this than this, it's most likely that in most cases, increasing taxes will also increase revenue. But is it a good thing? Subscribe and turn on notifications to be ready for our next video in which we'll cover this topic as well. That's all for today. Bye.